The Bureau of Labor Statistics released the June 2026 jobs report this month. And the headline number badly missed expectations. The United States economy added just 57,000 non-farm payroll jobs. Roughly half the 110,000 economists surveyed by Dow Jones had forecast. And it snapped a 3-month run of stronger than average hiring. The unemployment rate actually dipped slightly to 4.2%, which sounds encouraging until you look at why. And yet, on the day this week report landed, the stock market did not fall. It rose. The Dow Jones Industrial Average climbed about 246 points and the S&P 500 added roughly 0.4%. A hiring slowdown that makes stocks go up sounds backwards. It is not, but understanding why requires looking past the headline number entirely. Let us sort the signal from the noise. Look past the top-line figure and the report gets more concerning. Not less. Leisure and hospitality, an industry that usually adds jobs through the summer, actually lost 61,000 positions in June. The Bureau of Labor Statistics also revised down its estimates for the prior 2 months by a combined 74,000 jobs, meaning the hiring picture painted by earlier reports this year was more optimistic than what actually happened. And that dip in the unemployment rate to 4.2% came alongside a shrinking labor force. Fewer Americans were actively looking for work. Not more Americans finding jobs. When unemployment falls because people stop searching rather than because hiring picks up, it is a weaker, more fragile kind of improvement. One that shows up as a better headline number while describing a softer underlying labor market. Combined, a payroll miss, a leisure and hospitality contraction, sizable downward revisions, and a shrinking labor force point in the same direction, cooling faster than most forecasters expected. Here is the mechanism behind Wall Street's reaction. And it comes down to what investors think the Federal Reserve does next. The Federal Reserve had been weighing whether inflation, still cooling but not fully tamed, justified holding interest rates steady a while longer. A jobs report this week removed the possibility of a rate hike almost entirely from near-term conversation, and short-term Treasury yields fell on the news. Both signals that traders now expect the Federal Reserve to cut rates sooner rather than later. Lower interest rates make borrowing cheaper for companies and consumers alike, and they tend to push stock prices higher. Which is the specific reason markets can rally on what looks, on its face, like bad economic news. This pattern has a nickname among traders. Bad news is good news. And it shows up repeatedly whenever weak economic data raises the odds of looser monetary policy. It does not mean investors think the economy is doing well. It means they think cheaper borrowing is coming. There is a second thread worth pulling. Because hiring is not the only measure of economic activity right now. While payroll growth cools, business investment in equipment and intellectual property products has been surging, up around 10.6% in recent data, driven substantially by companies pouring money into artificial intelligence infrastructure, data centers, chips, and related build-out. Gross domestic product for the first quarter of 2026 grew at 2.1%. And forecasting models were estimating a slower but still positive pace for the second quarter as of early July. So the economy is not contracting. It is running on an unusual split. Heavy capital spending on AI infrastructure alongside a labor market that is adding far fewer jobs than it was in the spring. That split matters because it means the jobs report alone does not describe the whole economy. A lot of current growth is concentrated in a capital-intensive sector that does not need to hire the way retail or hospitality does to expand. Here is where the caution belongs. 1 month of data, even a weak one, is not a trend on its own. And jobs numbers get revised, sometimes substantially, in the months that follow. So the 57,000 figure itself could still move. A stock market rally built on rate cut expectations is also a bet on the Federal Reserve's future decisions, not a statement that the underlying economy is healthy. And if the Federal Reserve does not cut as quickly or as much as markets currently expect, that rally has room to reverse. The AI investment surge propping up growth numbers is also concentrated in a relatively narrow slice of the economy. A small number of large companies spending heavily on infrastructure, which is a different and more fragile kind of growth than broad-based hiring and consumer spending. Across many sectors, relying on one sector's capital spending to offset a genuine slowdown in hiring elsewhere is not the same thing as a resilient economy. And the gap between those two stories is exactly the part that headlines tend to flatten. Quick recap. June's jobs report showed the United States economy adding just 57,000 payrolls, against a forecast of about 110,000, with sizable downward revisions and a leisure and hospitality contraction. Even as stocks rallied on expectations of a Federal Reserve rate cut and business investment in AI infrastructure kept overall growth positive. So, signal or noise? Split verdict. Signal. The labor market genuinely is cooling faster than forecasters expected. That part of the data is solid and consistent across payrolls, revisions, and the shrinking labor force. Noise. Treating the stock market's reaction as evidence the economy is fine. It is a bet on future rate cuts, not a verdict on current conditions. And it says nothing about whether AI-driven investment can keep offsetting a real hiring slowdown indefinitely. Watch the next jobs report and the Federal Reserve's actual rate decision together. They will tell you far more than one day's stock market reaction did. Subscribe for the economic numbers explained before they become talking points. Signal from the noise. Every week,